Hello, financial mavericks. Welcome back to Irene Consulting Firm, your go-to guide on a journey through the vibrant world of finance. If this is your first time here, we enthrall our audience with the latest tips, insights, and intriguing explorations into the monetary universe. Today, let's demystify two fundamental banking tools: checking and savings accounts. It might sound basic, but do we truly grasp their potential and discern their distinctions? But before we start, hit that subscribe button for more informational videos. Number 1. Unveiling the checking account. In the forefront, let's chat about checking accounts. Imagine a financial tool intricately woven into your daily transactions, offering seamless access to your funds. It's typically used for everyday expenditures like groceries, coffee hauls, or that delightful online purchase. They come with debit cards, checks, and unfettered online accessibility, shaping them into quintessential instruments for your daily monetary maneuvers. But wait, there's more. They often flaunt features like online bill payments, direct deposits, and sometimes even yield a dash of interest on your balance. But remember, they're not typically designed for growing your wealth. Number 2. Saving account, the wealth builder. On the flip side, meet the savings account, your personal financial gardener, nurturing and escalating your funds over time. Unlike its checking counterpart, savings accounts boast higher interest rates, making them an excellent alcove for your emergency funds, vacation piggy banks, or that dream bike saving plan. Marvel as your money, tucked away in a savings account, potentially flourishes over time thanks to the marvel of compound interest. But alas, accessibility comes with boundaries, often limiting withdrawals to maintain the sanctity of your growing funds. Number 3. Navigating the differences. Navigating through the fiscal sea, the disparities between checking and savings accounts become evident. While checking accounts emerge as champions of liquidity and transactional ease, savings accounts dawn as the meticulous wealth accumulators, silently amplifying your funds over time. Do remember, frequent transactions, online purchases, and bill payments are the realms where checking accounts shine. Yet, for the attainment of financial goals and nurturing a safety net, turning to a savings account becomes imperative. Number 4. Choosing wisely and managing both. Pondering upon which to choose? The savvy path intertwines both. Utilizing a checking account for daily expenditures and maintaining a savings account for future aspirations and emergency funds crafts a balanced financial narrative. Establishing an equilibrium where your funds are effortlessly accessible yet simultaneously germinating paves the path towards a serene financial future. Mastering the art of managing both accounts effectively is a skill that, once honed, can potentially steer your financial ship towards tranquil seas. Number 5. Overdraft protection. One key distinction between checking and savings accounts is the concept of overdraft protection. Checking accounts often offer overdraft protection, which means that if you make a transaction that exceeds your available balance, the bank may cover the difference and charge you an overdraft fee. This can be a helpful feature to prevent declined transactions or bounced checks, but it's important to be aware of the associated fees. Savings accounts, on the other hand, do not typically offer overdraft protection. They are designed to encourage saving and may not allow withdrawals that exceed the available balance, preventing you from spending money you don't have. Number 6. Transaction limits. Checking accounts are designed for frequent transactions, and there are usually no limits on the number of withdrawals or transfers you can make in a month. This makes them ideal for day-to-day expenses and managing your cash flow. Savings accounts, on the other hand, are subject to federal regulations that limit the number of certain types of withdrawals or transfers to 6 per month. These restrictions are in place to encourage saving and prevent excessive use of the account for frequent spending. If you exceed the allowable number of withdrawals, your bank may charge you a fee or convert your savings account into a checking account. Number 7. Interest rates. One of the most significant differences between checking and savings accounts is the interest rate they offer. Checking accounts typically offer very low or no interest on your account balance. They are primarily designed for convenience and easy access to your money, not for growing your wealth. Savings accounts, as mentioned earlier, offer higher interest rates compared to checking accounts. These interest rates can vary from one bank to another, but the key takeaway is that they allow your money to grow over time. This is especially beneficial for your emergency fund or any savings goals you might have. Number 8. Purpose and goals. When deciding between a checking and a savings account, it's essential to consider your financial goals. If your primary goal is to have a place to manage your daily expenses, pay bills, and make frequent transactions, a checking account is the way to go. It offers convenience, accessibility, and a range of features for managing your day-to-day financial activities. On the other hand, if your goal is to save money, build an emergency fund, or work towards specific financial objectives, a savings account is a better choice. The higher interest rate allows your money to grow, and the limited access can help you resist the temptation to spend your savings impulsively. Number 9. FDIC insurance. Both checking and savings accounts at reputable banks are typically protected by FDIC, Federal Deposit Insurance Corporation, insurance. This insurance guarantees that your deposits, up to a certain limit, usually $250,000 per account holder per bank, are safe and secure even if the bank experiences financial difficulties. Number 10. Combining both for financial success. In an ideal financial strategy, it's often beneficial to have both a checking and a savings account. By using a checking account for daily expenses and a savings account for saving and growing your money, you can strike a balance between accessibility and wealth accumulation. Consider automating transfers from your checking to your savings account on a regular basis, ensuring that you're consistently saving a portion of your income. This can help you reach your financial goals while still having easy access to your funds when needed. Ahoy, intrepid fiscal explorers! If you're finding value in navigating these monetary waters with us, do hit that thumbs up, subscribe, and ring the bell to be notified of future explorations into the enigmatic universe of finance. Write your thoughts in the comments below. Your support propels us to curate more content, unraveling the often enigmatic world of money, savings, and investments. Should you need a bookkeeping or payroll services, reach out to Irene Consulting Firm. We will be happy to assist you. As we sail towards the horizon, remember, the confluence of a checking and savings account lays the foundation for a stable financial journey. Your checking account is the bustling port, facilitating your everyday financial exchanges, while your savings account is the tranquil sea, quietly amplifying your wealth, undisturbed. Navigate wisely, dear sailors, and may your monetary vessels always find favorable winds. Thank you for voyaging with us today through the seas of checking and savings accounts. Cast your thoughts and queries into the comment ocean below, and we shall navigate through them together in upcoming adventures. Until next time, keep sailing, savvy savers.